So this week we have more than 150 companies reporting on the S&P 500, but just 4 of them represent $6 trillion in value. That's Microsoft, Alphabet, Amazon, and Meta. Meta, of course, reporting this week. Stakes are high, especially after Tesla's flop, one of the participants in the so-called Magnificent Seven. We're going to get some shareholder perspective into Meta. We've got Jason Del Vicario, portfolio manager at Hillside Wealth Management, part of IA Private Wealth, joining us now. Jason, thank you so much for being with us. How are you thinking about the setup for Meta? Are you thinking about the bond market, yields, where expectations are? Put your investor hat on for us.
Sure. Good morning. So yeah, I mean, we think years, decades down the road, and don't necessarily focus on the short term, but putting our short-term investor hat on, if you will, looking at Meta, we're looking to see whether their moat is widening or narrowing. And some of the cues that we can get in terms of how they're doing would be to look at their daily active user, maybe also the ratio of daily active user to monthly active user, which will give us a sense for engagement. Also having a look at what they're doing with Reality Labs, the metaverse. Of course, that's consumed a lot of capital over the last little bit, and so we want to see how that's going. And then also have a look to see how their expenses are coming along. As you are most likely aware, they laid off a number of people. Mark Zuckerberg was under a lot of criticism in terms of him just spending and spending and spending on the metaverse and not really paying attention too much to expenses. And so they've really reined that in. And, their earnings expectations are strong. I think we're looking for revenues up 20% year over year, earnings in the sort of high $3 range, which is significantly higher than they were this time last year. So Meta is a strong company firing on a lot of cylinders here. And we expect them to continue to perform strongly.
Their revenue, as you mentioned, is expected to reaccelerate, and the stock has held in extraordinarily well in the face of a pullback in the NASDAQ 100, a sell-off in the bond market. Are there other names within tech that you think are able to do the same thing that Meta has been able to do in terms of, withstanding kind of the industry cross currents?
That's a really good question. If you look at a longer term chart of Meta, I mean, Meta went from the high 300s all the way down to below 100 and is now recovered to the low 300s. So, in that context, there was a very large drop followed by, really a re-rating back to what we would think would be sort of a reasonable valuation. Meta is also, I mean, you could almost argue that they're a bit cheap. I mean, I think they're trading at a forward earnings multiple of 19, which I think is relatively inexpensive for a company that is so well moated. But our largest holding is Constellation Software, and I know they're not necessarily a direct technology company. They are a sort of a roll-up or serial acquirer where they're buying vertical market software companies, but they are a tech company, and their stock price has held up unbelievably well in the face of the NASDAQ, struggling and what have you. So that would be one that I would call out. Microsoft has also done quite well, which is another position that we own, although I would caution that Microsoft and Constellation are a little bit more richly valued, shall we say, than Meta.
On Constellation, because it is a roll-up strategy, you would think that higher rates would impede that strategy or at least make investors nervous. How should we think about higher rates as it relates to Constellation?
That is an awesome question. So it is actually the opposite, and you're right. I think intuitively, or the narrative would be that it would hinder acquisitions. However, Constellation Software, their main competitor are private equity, and private equity rely heavily on debt to fuel their acquisition machines. Whereas Constellation Software, if you look at their balance sheet, they do have some debt, but it's very small in relation to the size of the enterprise as well as their free cash flow. So during periods of economic uncertainty and higher rates, and I suspect this is why Constellation shares have held up so well, their competitors fall to the wayside. And so they are competing against fewer people in terms of when they're going to make these types of acquisitions. acquisitions. In addition to that, because they're competing less, presumably the valuations are also lower. So they're competing against fewer people and the deals that they're doing, and they've accelerated their deal flow, which is unbelievable, especially considering the size of the company. So as they scale up, the fact that they've been able to consistently increase the amount of deals that they're doing is really quite impressive. So this is one of the few companies that benefits when other people, well, I shouldn't say one of the few, but they benefit because their main competitors are hurting because of higher rates.
Well, are they also being cautious, though, because they're worried about maybe a cloudy economic outlook and businesses pulling back in tech spending? So, are they kind of out there and maybe it's risky to be out there buying these businesses at this time?
So Constellation Software has been around since 2006. They've done approximately 650 deals since that time. I've read all of the president's letters from Mark Leonard, and they do not think in terms of months or even years. They're thinking decades. In fact, during their acquisition spree, if we want to call it that, they've only actually ever sold one business. So they want to be forever holders of these businesses, and they accept, just like anybody with a long-term mindset, that there's going to be bumps along the road. And in the context of bumps along the road, it's when we have those bumpy periods where maximum opportunity exists. So, Mark Leonard says his only regret from the 2008 experience was that they weren't more aggressive. They've recently done a debenture issue, and what that tells me is they're sort of shoring up the coffers to be more aggressive should what you just described transpire, where spending gets pulled back and, of course, then valuations come down. So I think that's a scenario where they would really thrive.
Clearly, you've been adept at finding these players that can withstand whatever is happening kind of in the macro environment and with rates. But still, when you look at your portfolio, are you making adjustments for, call it a 5% world in terms of your allocations?
Yeah. So, this is the golden question. Warren Buffett talks about, how interest rates really drive everything. And that is absolutely true. Again, when you think in terms of decades, you accept that you're going to have periods of high rates, high inflation, low inflation, increased geopolitical activity, relatively calm geopolitical activity. And these things are certainly outside of our control. What I will say is long duration assets, so long duration bonds, as well as the types of companies that we look at. So when I'm talking about decades, and I'm talking about Constellation Software has been around for decades, and we think that Meta is going to be around for decades, and say Alimentation Couche-Tard, these are by definition long duration assets. And the price of long duration assets will be more susceptible to volatility based on what the discount rate, in this case, interest rates, will do. So again, I think if you have a long-term mindset, these types of situations or conditions present opportunities because long duration assets will sell off. But no, we are not necessarily looking and saying, okay, now we're in a 5% world. Are these companies, we'll sort of say pull up a list of companies that maybe are disproportionately affected by higher rates. Should we ditch them? Rather, we're much more bottom up. So we're looking at are the competitive advantages and the moats that exist in these businesses still there? Are they widening, narrowing? We're much more focused on that. But I will say it's like, higher rates is like swimming up a river. There's absolutely no question that it's challenging for investors on, be it equity or bond investors on all fronts, no question.
Jason.